morning, everyone, and welcome to today's webinar. My name is Alex Paul from InvestorStream, and I'll be your host today. Presenting to you this morning is AXP Energy Chief Executive Officer Tim Hart and Chief Operating Officer Greg Grotke, who will be discussing the company's performance for the quarter ended 31 December 2022 and the key objectives for the upcoming quarter and throughout the calendar year of 2023. There'll be a short presentation on this progress, and Tim and Greg will be on hand to address any questions following the presentation. The presentation is currently being uploaded to the ASX, and so you should be able to download it from that platform very shortly. A copy of the webinar will also be available on AXP's website and social media platforms today. But without further ado, I'd like to throw it over to Tim to kick things off for us. Tim, the floor is yours.
Thank you, Alex. And thank you all for tuning into the webinar today. In the presentation, we're going to be going over our Q2 results, and then we'll have an operational discussion about this blending issue that has been so impactful to the business as well as other things. And further, we'll discuss a few details about our fields as well as some of our near-term plans. I am pleased to be presenting with Greg Grotke today. And as many of you are aware, Greg's our interim Chief Operating Officer and has been intimately involved with the business for the last several months as we've worked towards solving some very difficult legacy issues and develop our plans forward. And although you've had some introduction to Greg with his InvestorStream interview several months back, for those who missed it, Greg comes to us with a significant background in oil and gas, with 30 years of experience in various technical and leadership roles at companies like BP, Amoco, and Noble Energy, and he's a welcome addition to the team, and I feel privileged to be presenting with him today. With that said, can we advance to slide 3, please, Alex? So this shows our net revenue broken down by hydrocarbon. And although our quarterly net customer receipts were up 17% and we had a positive operating cash flow, there's a very noticeable 42% decline in net revenue. And so let's explore why that is. Well, 56% of this decline was related to a reduction in NGL sales. And this is directly due to the fact that we're not buying blend materials, which is a very good thing. And blending is a bit of a complicated matter, so we have a couple of slides dedicated to it later on in the presentation. The second largest contributor to the net revenue reduction is that there was a 37% drop in realized pricing. Commodities are softening and gas has taken a significant downturn. That said, we hung in there with approximately 1.94 million at quarter end. Next slide, please, Alex. So we had a 6% decrease in gross production, and a significant portion of that was reduced NGLs due to higher than usual direct sales. Oil and gas were slightly down due to the impacts of inclement weather, which is typical for this time of year. We did see a 6% uptick in net gas sales by volume due to performance improvements with our midstream provider, which I was really happy to see. And we held steady at just under 18,000 barrels of oil inventory. And as promised, we have a few detailed slides on blending that Greg will be presenting next. With that, over to you, Greg.
Thank you, Tim, and thank you for the introduction again. And really appreciate all those that have joined us today. This topic and this next topic about the NGL blending is quite complex. And so as we get into the next slide here, I'll start sharing some of those details in the overall blending challenges that we've faced. And then I'm sure that we'll hit some more details during the Q&A as well. So just to remind folks that have been in some of the prior webinars, you know that we've been dealing with blending for quite a while, and it is not a new issue for the company, yet it is something that really increased dramatically in late 2021 and throughout 2022. And the reason for that is because there are existing regulations in place related to the vapor pressure and the amount of pressure that can be in vessels, rail cars, or tanker trucks when they're on rail and road. And the most efficient, the best way to get hydrocarbons, oil, gas, and NGLs to market are pipelines. And with potentially no pipelines in the area or limited pipeline capacity, we look to rail, and the least efficient is typically trucking. So as we got into this last year with increased blending requirements, the only direction we had to go with our NGLs was rail to Texas. And so given that we were shipping our NGLs to a part of the country that is much warmer during most of the year, we had to deal with purchasing blending material and bring it up from Texas to Tennessee to blend with our produced materials, and then ship that blended material back down to Texas for sale. And that was the only market that we had all the way up until the first quarter of our fiscal year 2023. And you can see in the graph below, that is when we hit our peak problems and challenges with blending. So fortunately, we were working on other ways to get our NGLs to market, and we have at least one additional channel to market, and that is via truck to a facility in West Virginia. So now that we have at least two markets, rails to Texas from Tennessee, and trucks to West Virginia, that gives us a little bit more flexibility going forward in managing this. And we did get to the point at the end of Q4 of 2023, or in December, having a full month where we didn't have to blend any product, as all of our product moved via truck to West Virginia. So if you could go to the next slide, please, Alex. Now, when we start diving into the details of how this has impacted us financially, we look back and we see that when we sold a little over $3 million of blended material, it actually cost us over $7 million to receive that material. And the reason is because it was coming from a long distance. The material and the blend product from Texas had to be transported via rail, which is one of the most efficient ways to get product to market. However, we had to pay for blending fees and the time to receive that product and blend that product and move it back to Texas had carrying costs that negatively impacted us. But as I mentioned in the previous slide, we're fortunate to be able to find other access to market and other ways to ship our NGLs north and not have to deal with the warmer weather and the more volatile liquids, increasing that vapor pressure when that product is shipped to Texas. So as you can see on this slide, as we work through the issues and challenges in the bar graph below, you can see that we struggled to cover our costs, and we're continually losing money in this blending process while getting our gas to sales through that gas processing plant. So going forward, we're fortunate that, as I mentioned, in December, we had no blending requirements at all. And as we go forward, we'll continue to seek better markets and better channels to sales up north, so we won't have to deal with the hotter summer months in Texas. And one of these, the current market that we have going north to Texas or to West Virginia, does allow us to borrow the blending material. And when we've shipped that blending material down to Tennessee, blend it in the truck and ship it back, that doesn't have nearly the negative impact that we've seen in this process that we've been working to fix and have found solutions. So as we get into the summer months this year, we will continue to look for additional options and opportunities to reduce this cost that was such a burden for us this past year. So with those slides on blending, we'll move on to production rationalization and have Tim go ahead and talk a little bit more about where we're heading.
Thanks, Greg. So my intent behind this slide is to talk through our Appalachian Basin assets. And the Henry Hub natural gas spot price today is $2.65 an MCF. It's beyond question that this is going to have some impact on our business. And with our company primarily focused on gas production in the Appalachian Basin, this decline in natural gas price necessitates that we change what we're doing. And thankfully, we have a fairly diverse portfolio of assets that includes multiple hydrocarbon streams, as well as 16 different sales channels for the oil, gas, and NGLs that are produced. So 72% of our wells in the Appalachian Basin are dedicated to a single very high cost sales channel, as outlined by the red dotted line in the image. And at current prices, gas sales through this sales channel is not profitable. There are 7 different direct sales customers and 62 oil wells within this area that are profitable, and we'll continue to operate and enhance the wells that service these sales channels. At the same time, we'll continue to work with our midstream partner to improve our margins within the AMI, but we cannot operate these at a loss. And the reality is that we've inherited a very difficult sales channel here, and we've been working to try and improve it, and we'll continue to do so. However, we do have 8 fields outside of this area that sell into other sales channels at a much higher profit margin. There's about 320 wells in these 8 fields that account for approximately 24% of our total gas production. And these fields are shaded in green on the map. The upside is that these fields have had very little work and have a tremendous amount of upside. So at current gas prices, our focus will shift to oil and gas production in these fields. And to date, we've only been focused on our KJ field. And Greg will provide some additional commentary on this field in the next slide. Back to you, Greg.
Tim. Thank you, Tim. So in that slide that Tim was just reviewing, you'll recall that KJ is off to the west of the area that we were just talking about. And in the KJ field, and as we zoom into the KJ field, we have 236 wells currently in the KJ field. And we're working on all of these wells to increase production. The current production is a little over 1 million a day. And when AXP Energy first acquired these assets, that production was around 200 a day. So we've had a 5-fold increase in this field over the last couple years. We have some favorable pricing, and we have 32 wells that have been tied to new pipelines and have enhanced production. And you can see the pipelines that have been replaced and enhanced in blue on this slide. And what that does is allows line looping and the ability for gas to flow in a couple of different directions and in a couple of different ways through the field. It also enables us to prepare for recompletions that you've heard us talk about in the past. We had a couple of recompletions last fiscal year out in Haley's Mill in the Illinois Basin. And we identified 5 recompletions this year and have already completed 3 of those 5. Some of these may be familiar to you. We've had a number of questions recently about the Terry Carroll number 3. That was our first recompletion. And then we have 2 other recompletions, HE61 and HE68, up in the upper left portion of this slide. And we are flowing back these wells. And one of the things that we have learned, and you know, Alex, can you go back to the previous slide, please? As we go back to the previous slide, if you look to the west side of this slide, you'll see a number of blue lines around that KJ field in the west side of this slide. And that is another offset operator that has done a tremendous amount of work similar to the recompletion work that we're doing. So thank you, Alex. You can go forward 1 slide now. So as we get into this work, one of the things that we've done since I joined the company about 3 months ago, and I can't believe that it's just been a little under 90 days, and we were talking all about the recompletion opportunities and the pay behind pipe. One of the things that we've done is really looked at that offset operator and what they've done and how they've been successful in what they've seen as highly variable results in their recompletions. Yet we do have the ability, with the log control that we have and the offset work from the offset operator, to know that there are hydrocarbons behind pipe, both gas and oil. So these are the opportunities that we've been focusing on these last few months. However, given the current price environment, one of the things that we've decided to do is to hold off and not pursue those next two recompletions in the next few months. And we'll wait until we have more favorable commodity pricing to move on the next two opportunities. Now, with that said, we have over 100 wells that we can work on like this. Yet in the current pricing environment, we're going to continue to analyze and understand what we can learn from the offset operators, the existing logs that we have in these wells, and be prepared when we have a better pricing environment to go after these recompletions. So with that, on the next slide, I'll let Tim go ahead and share some of those near-term focus and adjustments to where we're heading here in the near term. So you can go to the next slide, Alex.
So with the current environment with gas prices, we're going to be doing some restructuring and cost reduction efforts, and those things are all underway right now. We are identifying and assembling all of our lowest net revenue interest wells, and those wells are on deck to be shut in. We're considering divesting of some non-core leases that we've had difficulty and challenges with getting the margins that we've wanted to throughout the time that we've owned them. And as you know, as we suggested, we'll be shutting in wells with high cost transport and processing. We really don't have a choice. It certainly isn't our we're not happy about this, but you know, we've got to make sure that we're healthy going forward in this new price environment. And one of the things associated with that is lower TGC costs, and so our transportation and gathering costs will be reduced substantially as we're able to reduce production inside of these high cost fields. The other thing that you always have to be mindful of when you come into an environment like this with the low gas prices are, you know, there's a lot of people that just don't have the stomach anymore for low gas prices, and so we've got to be looking out for those opportunistic acquisitions that are possible, and potentially some JVs, and you know, and maybe divesting of some of our other assets can help us take advantage and leverage some of these items that might come onto the market as a result. So we're continued to focus on margin improvement and growth for the new pricing environment. As Greg mentioned, we've reduced our reliance on blend material in the winter. As it's colder, we don't have to blend because the temperature inside the transport vehicle doesn't increase as much. And we are working towards coming up with a similar solution in the summer. We think that we have this mostly solved, but we've got some more testing to do once the weather becomes warm. We're going to grow and stabilize the oil production. We've got to work on our logistics. There's a bunch of wells that need work. A lot of low-hanging fruit that we can attend to, and also growing our gas production outside of our largest sales channel until we can secure better terms and/or we get better pricing. Next slide, please, Alex. Greg, did you have anything you wanted to add on that last slide?
No, that's good, Tim. And I believe we'll probably get some more questions about where we're heading. So yeah, I think we're looking good as we get towards the end of the slide deck here.
Yep. So this slide, for those of you who have stuck with us for a bit, will not be a new slide. And we're discussing it today because the strategy of our value creation has not changed. Our acquire, enhance, and produce is well in effect. And the good part about it is I feel like we're operating in an area that's conducive to this. It's in Southern Appalachian Basin. It's highly segmented, and there's lots of opportunity for us to consider expansion through picking up assets that are in distress as we move through these challenging times. So with that said, that concludes the presentation, and I'll turn it back over to you, Alex, to move through the questions.
Thanks, Tim. Thanks, Greg. Look, we will get started on the questions now, and I'd just like to start, if we can, with the elite mining operation in Colorado. So, Tim, following the current modifications and upgrades, a couple of questions here. Firstly, at what approximate date will the elite mining project be fully operational from a gas supply point of view? And then approximately on what date will AXP be able to exploit these associated oil reserves for sale to third parties?
Alex, I'm gonna give a more general answer for this. The elite mining operation in Colorado will be fully functional, or is scheduled to be fully functional this quarter. We have made some very good progress there, and we were actually running the site for an extended period of time, but had some difficulties with the third party that was responsible for supplying the power generation. We're the gas supplier. There's a third party that's supplying power generation, and then Elite Mining is supplying the EMUs and the computers to do the cryptocurrency mining. So we've been through a couple of iterations with this, and we've got a new third party that is bringing generators in. The team was actually on site, Elite Mining, this new third party, and our group all day today. And the new generators are supposed to be moved in this coming week. So once those generators are moved in, we will connect them up to the system and fire them up. And if they are reliable, then we have a fully functional mining operation in Colorado. So
just on that, once both the gas and oil reserves are able to be exploited, what are the projected effects on AXP sales and profits?
So a couple of things here, Alex. One is, we're starting with a small mining operation. We anticipate this initial operation to be 400 MCF per day at full production. But one of the things that I want to point out is that the Colorado assets are just a small part of our asset portfolio. And so our primary focus, although I'm very excited about getting this mining operation up and running, our primary focus still remains in the east, in the Illinois Basin and the Appalachian Basin.
Thanks, Tim. Now, I'd like to turn this over to Greg, if I can. So we've had a number of questions come through about pricing, especially oil price in particular. Firstly, Greg, could you just clarify the pricing that we're talking about here? What's that based on? Is it Brent or US NYMEX or WTI?
So we do look at the US NYMEX and WTI and do not tend to look at the Brent pricing. And so that's focused on the US pricing index because all of our producing assets are in the US.
Thanks, Greg. So what was the average gross price achieved in the quarter, and what expenses are deducted from the gross price we get to arrive at AXP's net price of US $32.48 barrel of oil equivalent?
Okay, so I do not have the gross price this past quarter in front of me right now, but one thing that needs to be clarified, or one thing that is probably worth pointing out, is that the net price is calculated based on our net production sales and our total revenue. And so with asking about what drives a net price of $32.48 per BOE, I think was the number that you shared there, Alex?
Yes, that's correct.
Yeah. So that sounds like a very low price for a barrel of oil equivalent. But keep in mind that 60% of our production is natural gas. So just this week alone in the United States, the BOE pricing for natural gas is about $15 a barrel, or $2.50 an MCF. So that is a part of what drives our price. Now we have another about 20% in NGLs and 20% in actual oil production. So that's what drives our focus now, and what Tim finished up in the end of the presentation on looking at where can we increase our oil production, say in the Illinois basin, and even to some extent in Colorado, where we can get more liquids production, which would then drive up more revenue and an increased price per BOE.
So the world oil price yesterday was reported at Brent was US 82.84, and you've acknowledged that you don't quite focus on that one as much. But US NYMEX was US 76.41. But AXP only achieved an average price of US $32.48 BOE. Where does the difference go?
I think I was able to address that quite a bit in the previous answer. And just another thing to reiterate on top of that is a blend. The BOE is 60% natural gas, roughly 20% NGLs, 20% oil. It also is a net price. So, when you look at what we produce at the wellhead and the fuel that goes into the compressors to get the gas to the gas plant, 20% goes to NGLs, roughly, and then 80% of that gas stream goes to gas sales. And so we also have to pay our royalties on to go from gross to net as well. So the landowners, and that is something that is unique here in the United States. I do believe we have a number of people on the call in Australia and elsewhere around the world, and be very similar to the taxes and royalties that are paid to the governments that own the mineral rights in other countries. But we have numerous landowners that we pay off of the top of our revenue. So the combination of royalties, fuel, shrink, and loss in the system, and the product mix is what drives that lower price per BOE.
So, Greg, just to sort of finalise the discussion around pricing, broadly speaking, what's your view on the outlook for hydrocarbon prices, both short term and maybe for the second half of the calendar year?
Alex, we certainly hope we see some recovery, certainly on the natural gas price that we've currently seen. We know that here in the United States, we've had some challenges in exporting and offtake of natural gas, along with the past quarter or two. I'm sure we are not the only company that was looking at some very high gas prices up around the $8-9 an MCF range, and thinking about what additional projects we could do to take advantage of those higher gas prices. And now we're in a much lower price environment. So while we look forward to a little bit better gas pricing going forward, oil has hung in there, and the pricing, you look at the last, say, 6 months, we've seen more than a 70% drop in gas price, less than 10% drop in oil price. So if we could maintain, or we may actually see oil drop off a little bit, but we're working our business and managing our portfolio of assets no matter what the pricing environment is, and that is something that we will continue to do and continue to communicate to our shareholders as we go forward.
Thanks, Greg. We've had a number of questions coming through regarding production as well, so we might move on to that now. So as it's currently constituted, AXP had kept approximately even levels of production across the last 5 quarters. We're talking roughly 200,000 BOE per quarter. Has not raising production been a strategic move due to improper margins and relationships with other off-takers? And I guess further to that, do you see that increasing production by 50% to roughly 30,000 BOE per quarter is something that needs to be done or can be done?
Certainly, Alex, I'd say that we could take a look at the pay behind pipe and the opportunities to accelerate our recompletions to shoot for a 50% increase in production. However, in the current commodity pricing environment, that would not be wise, and that is not something that we look forward to doing here in the near term. As far as the 5 quarters previously in flat production, we are very fortunate to have an operations team that has been able to maintain production and identify projects to incrementally add new production and replace reserves while we've maintained this production. There's another operator in the area, a leading operator that touts an 8.5% decline on their base production. And in our base production, we do see 4, 5, 6% decline in our base production, yet we have to work hard to maintain that flat production that we have maintained over the past 5 quarters. There are other operators that may see base production decline rates 20, 30 plus %, and those tend to be the larger operators further north in the Appalachian Basin, and a lot of operators that have much greater capital investment programs in place and are out drilling shale wells, bringing on a lot of new wells, and it makes it more difficult to maintain production and to grow production. As this person is asking, what would it take to get that 50% increase in production? With higher commodity prices, we may consider or look towards when it would make sense to increase our pace of capital investments and bringing on new production. Yet at this point in time, looking to maintain production and replace reserves has been a place that we have been the past few quarters and will likely be in the next few quarters ahead.
So, Greg, regarding oil production, the announcement stated that the oil revenue fell 39%, predominantly driven by a fall in realized commodity prices. However, the announcement also states that the net oil sales fell by 1 quarter and realized oil price also fell by 18%. Is there a reason why management is attributing the decline in oil revenue primarily to softer pricing instead of sales volume decreases?
Alex, I believe in the announcement and here in the presentation, we've talked about it being a little bit of both. It is a combination of the pricing along with the sales. And one of the things that Tim has pointed out in the past, and something that for those that are potentially halfway around the world and enjoying the summer months, we are coming off of what was a very brutal winter and holiday season, and hopefully we're recovering from that. Yet, even with the oil that was produced, we did have some challenges getting that oil to market with the brutally and cold conditions that we had over the holidays, and also with the work that we had to do after the floods late last summer to repair the roads. So we do look forward to hopefully an early spring and an opportunity to move more oil to sales in the near future. And so to answer this question, though, it was a combination of both the pricing and the sales volume decreases.
So just to sort of clarify that and sort of, I guess, alleviate that point, Greg, if oil sales quantities decreased by 26%, but production remained almost flat, gross production chart we're using there, why has unsold inventory remained static?
Good question. That's a really good question. That's actually something that our CEO, Tim, brought up as we were putting the quarterly together in looking at the inventory levels. And as I mentioned earlier, and as most of you are well aware, certainly those that are in the United States, we had some major disruptions in supply chains and the weather that hit us between Christmas and New Year's, shut down a number of airlines and had a number of issues that we saw across the country. And one of the things that I think could have happened here, and this is something that as we look forward to a little bit better weather, is if you think about the hundreds of oil tanks that we have and the inventory that we have out in the field, there is a possibility that our wells have been flowing into these tanks. And the way we measure this inventory is we have pumpers, lease operators go out to these tanks, strap the tanks, visually inspect the level of oil in those tanks. And that is something that with the challenges in the weather, there may actually be some more inventory out there than we were able to record. So hopefully that is the case. But that is something that I really appreciate that question and look forward to seeing where we're able to recognize inventory and additional production and sales in this quarter.
Greg and Alex, if I might just interject there, one of the things that I'm not sure that we have clarified to the degree that we need to is that the oil production in the East is in the mountains. You never hear us talking about having trouble getting our oil sales to our oil to the sales points in Colorado or even in the Illinois basin. And that's because the terrain in those areas is not anywhere near as challenging as the terrain in the Appalachian basin. We have 600 and some odd oil tanks that are scattered throughout the Appalachian Mountains, and the elevation difference between where the roads are versus where the tanks are is very significant. And these vacuum trucks that we have to send up there to grab that oil, I mean, they are really put to the test every single day. And so the logistics of oil collection in the Appalachian Basin is one of the, I dare to say, one of the largest challenges that the operations team has. And I'm not sure that the market understands that. So just wanted to clarify.
Yeah, Tim, that's a good point. And Alex, if you could go back to that KJ field slide, just to show a visual of those mountains, that I think that would be helpful. And keep in mind that the KJ field is further west and less mountainous than the extreme eastern Kentucky area. But that's a topo map or an aerial picture of where those wells are, up in the hills and foothills of the Appalachian Basin. So that hopefully that helps people that are dialed in and that have not visited our part of the country, our part of the world, to realize how rugged the terrain is. Thank you, Alex.
Thanks, Greg, and thanks, Tim. So, Tim, I might just address this one to you. I think we've laboured the production element of the question quite a bit. So, I mean, how long were the wells offline in Colorado? Are you looking at a reinjection well here?
So some of the wells were offline for the entire quarter. So it was very impactful from a production standpoint for the Colorado production profile. And the intent is to find a home for that gas. And the mining operation is our first sales channel for that gas. And so to the degree that we get that off the ground and expand that program, then we'll have a solution for that. A reinjection well, maybe that's something that we consider in the future, but right now we're primarily focused on developing a sales channel for it.
Thanks, Tim. Now, Greg, you touched on the NGL production and the blending in the presentation. So we've had a number of questions that come through. So it might be worth just sort of going through that again, maybe just to clarify and answer these questions for us. So the company has noted a key area of focus is to maintain the new NGL production arrangements with no blending requirement. Is there a quota or a limited service territory or any other factor where this requires active maintenance? And I guess what's the production expectation going forward?
So first on the production expectation going forward, one thing to keep in mind with the NGL slides that we shared is we were actually purchasing a tremendous amount of blend material from Texas via rail car up to Tennessee, blending and then shipping our produced product and blended product back down to Texas. So while the NGL production will remain somewhat flat or decline going forward, the amount of blend material needed going forward will be reduced tremendously. Now, I think in that question you also mentioned no blending requirement, and during the winter months, that's a goal. That is what we have been able to achieve in December, and likely will be able to continue with our channel to market in West Virginia. The limitations or the quota. Now, I would say there is this when we think about active maintenance. I think that this part of our business is actually taking up quite a bit of time and active management and understanding. And I think one other point that I should make that I'm not sure if it made it on the bottom of the slide, but the financial overview of the blending and how that impacted us, those are unaudited financial results. So, we're still working through the process of our internal audits and our mid-year review. Yet, as we take care of business from this past quarter and this past year, we look forward to having multiple channels to market and more effective NGL channels to market going north. And as mentioned earlier, we're very fortunate to have at least one additional midstream partner that is allowing us to borrow gasoline. Rather than using NGL blended with NGL, we're actually using a little bit heavier hydrocarbon, and that has resulted in less blend material needed to get our NGLs to market. So we do have some active management that needs to be done to make sure that we can get our NGLs to market, and we're fortunate to have at least one new third-party midstream provider that has been working very well with us in being able to move those NGLs to market, and we'll continue to look for other opportunities and options with our NGLs as well.
Thanks, Greg. So regarding your largest midstream partner, two quotes were made. The first was, and I'm quoting here, to add gas production volumes through both new well completions and improved arrangements with our midstream partner. And the second was, quote, reviewing current and historic charges and practices together with consideration being given to reducing well count. Investment in well recompletions and workovers is currently focused on areas outside of this sales channel. Can you just clarify those two statements, Greg? Because they seem to be almost at conflict with one another. Can you just talk us through those two statements if you can?
Sure, Alex. I'll tell you what, it's actually a bit of both. And you think about it, it's been less than 90 days since I joined the company in this position that I'm in. And the initial and first focus, let me clarify, the new well completions, that actually is new production behind pipe. So those are the recompletions. And we really have not been looking at drilling new wells, but we've been looking at bringing on new production. And the example of that that we've been talking about during this presentation is the past 3 recompletions in the KJ. So we have had those conversations, and we continue to have those conversations with our largest midstream partner. Yet we're also in a situation right now where, as Tim mentioned, we have a large number, an overwhelming majority of our wells within that area that's dedicated to our largest midstream partner that are uneconomic, and that we need to make some tough decisions on, whether or not we have the ability to divest wells, to turn those wells over to our midstream partner if they would like to take ownership or assignment of those wells. There's all sorts of things that we're looking at there, and we hope to have an opportunity where we can do more work in that area. Yet at this point in time, and given the current commodity prices, that is not an immediate focus. Those opportunities are likely going to be longer term, out in the years ahead, but certainly not in the months ahead.
Thanks, Greg. So have you decided to run a swab test on a sample of the wells that you're assessing for swabbing? And what level of increased production are you targeting as a result?
So we have been actively swabbing wells, and we have our own swabbing unit rig, and at times we have access to bring on another rig if we do want to bring on another swabbing unit. So the one thing that might be misunderstood here is the reason why we are swabbing wells or getting liquid off of the wells is because the way the wellbore configuration is and the lower reservoir pressures and flow rates that we have on these wells cannot unload liquids themselves. And so there's opportunities potentially for different types of artificial lift, and we can look at those types of investments to make in those wells, or we can look at sending a swabbing unit out to lift those liquids out so we can regain production on those wells. And so the increased production that we're targeting and what we always are looking at is, where has that well been historically? And what type of production rate? And we've got a large number of wells with a wide range of production rates, but we expect to see if we can get the production back to a near historic production rate. And so it is not a specific increased target rate. It varies depending on the well, and that's what helps us prioritize which wells we should be swabbing and focusing on.
So I guess further to that then, Greg, at some point, will the company begin issuing production quantity guidances?
Short answer is no. I think that the production is a result of the work that we're doing. And the work that we're doing is based on the commodity price and the opportunities to deliver production into the markets that we have. So rather than going back to a previous question, rather than increasing our production 50% and saying that's our goal, to increase production 50%, and then there have been operators at times that have gotten focused so much on that goal that operators will continue to spend more and more money trying to reach the increased production goal at continually decreasing and negative income positions. So focused on production quantity guidance is not wise without knowing and understanding what the commodity price will be in the future. So, it's a combination of managing what commodity prices we have before us and what type of work we have to do, and then we will move forward in maintaining or increasing our production based on the current economic environment that we operate.
So, Greg, do we have timing for completion of the software modeling program?
So the software modeling program that was mentioned in our quarterly is an economic analysis production forecasting model, and it is a newer application that is a software as a service model that helps us work more consistently and directly with our independent third-party reserve auditing firm. And rather than looking at it as a completion of the software modeling program, it's a continued process where we work on leveraging and using the capabilities of the software. For example, a couple questions ago, you were asking about the swab tests and what our expected production is on swabbing. And as I work with our entire operations team and we look at opportunities, we had one well that comes to mind where the well was expected to produce 30 or 40 MCFD, or what was about the current PDP reserves model. And we got the swab rig out there because getting an extra 40 MCFD seemed like a good thing to do back in November. And this well came online and produced 140 MCFD throughout the entire month of November, which was about the production rate that this well had back in 2011. So using this software to run our business enables us to be able to have a closer relationship with our independent third-party reserve auditors and putting that annual report to practice and into action on a consistent basis throughout the year. And it also enables us to be able to leverage software to fill in some of the areas of reservoir engineering and production engineering and areas where we've looked for outside resources to come in and work on specific projects. And so this is an ongoing software application program that we'll continue to use in our operations going forward.
Thanks, Greg. Look, a couple more questions before we finish up today. Now, the company, as we've sort of discussed over the past 12 months, there appears to be some recurring issues with the company over the past 12 months in terms of midstream processing outages, the NGL sales channel, vehicle outages, blending problems, etc., which we've all addressed already on the webinar so far. What are you putting in place to ensure that the company continues moving forward to resolve these issues, which hopefully result in a more output of gas and oil and lifting profitability, etc.?
You know, I would say as I look back at the past 3 months that I've been with the company and the 12 to 24 months where we've seen a number of different challenges going back to coming out of the COVID lockdowns, one of the things that I think that we've done historically is we've looked at what is our plan and what is plan A. And so you think about the NGL sales channel. We had plan A and only plan A. NGLs are processed and come out of one plant and go to one market in Texas. We now have a plan B and we're looking to plan C. And so similarly with vehicle outages, it is wonderful to be able to join a company that has the resources and combination of people and equipment to be able to do our own work. And quite frankly, I've worked with a number of different operating and production companies that don't have their own truck fleets. So it's nice to have our own trucks and be able to haul our own oil with our own vac trucks. One of the things that I think Tim mentioned earlier in the call, and one of the things that we put in place is a variable resource or a secondary third party that can come in and move more oil along with us and alongside us. So that's a plan A and a plan B. The blending challenges, we've talked quite a bit about that. We have that market in West Virginia, and we've also tested a market in Pennsylvania. We'll continue to look for those opportunities. And I think if we go back and look at the workovers and the recompletions, and you know, we have a number of different opportunities to pursue to help with more oil and gas output, and we're really looking forward to a bit of a rebound in our commodity pricing before we get after those additional workover and recompletion opportunities.
Alex, if I may interject on that question as well, I'm sorry to interrupt, but you know, some of these problems that we're faced with are very complex. And some of them came out of left field. Nobody was expecting blending to manifest itself, you know, into our production woes like it has. You know, some of the challenges that we have with, you know, with our midstream relationships, they're very complex challenges and problems. And you know, so one of the solutions or one of the things that we've put in place that Greg didn't mention is Greg. To have somebody with Greg's background and his experience and leverage that experience to help us solve some of these problems is already paying dividends. And so I don't want that fact to be lost on our investors.
Well, Tim, thank you very much for that. And I think, you know, you'll probably remember that it was either my first or second day in the office. I could not believe how much time we spent in the morning trying to figure out, you know, some of these challenges and where we need to go with NGLs and how we move forward in moving product in different directions to be able to get back to profitability as the commodity prices are dropping, and then having an 11:30 meeting and realizing that the entire morning is gone and we haven't even talked about a single well. So this is, I'm really looking forward to the times ahead when we have more of our day back and the ability to talk about the wells that we operate and not try to solve all the problems downstream and challenges that we've faced here in the past few months, and that you and your team has faced for a couple of years now. So we are looking forward to the opportunities and continuing to put in place alternatives to some of the single channel markets that we have. So we'll continue to do that. And thanks again, Tim, for those kind words. And thank you, Alex, as well.
Thanks very much, Tim, Greg. Well, that's all the time we have today. Thank you all for joining me. And I'd also like to thank Tim and Greg for presenting and taking the time to answer some questions, some really in-depth answers there. So I really appreciate that. Now, as I mentioned before, a recording of the webinar will be on AXP's website and social media platforms later today. Tim, before I let you go, do you have any final comments to leave with us today?
Yeah, a couple of things. We're entering into some challenging times right now, and it's just part of the cycle of oil and gas. And right now, the gas price is very, very low. Fortunately for us, we have a very diverse set of assets to work through it. And with 16 sales channels and 3 commodities to work with, we've got plenty of tools at our disposal. So I know that we're headed for some challenges. We're in them, but I really feel like we have the assets and the resources to weather the storm and come out on the other side much, much better. And I'd also like to thank our valued shareholders for the continued confidence in us. I'd like to thank our board of directors for their continued guidance, but also our associates who work very hard every day to continue to move this business forward. Nothing would happen without them, and I'm grateful for all of them every single day.
Fantastic. Well, look, that wraps it up for us here. Thank you, everyone. Have a great day and all the best.
Thank you, Alex.
Thank you, Alex.